Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today is Tech Tuesday, but I also comment on Fannie and Freddie and overvalued financials. My first blip looks at Apple, Google, the NASDAQ, and the Philadelphia Semiconductor Index, the SOX. For Apple, I show a negative weekly chart with a downtrend connecting lower highs. This indicates risk to monthly value levels at 142.35 and 120.15. There is also a downtrend for Google on its weekly chart. The stock is below its 200-week simple moving average at 422.09 for the first time since becoming a publicly traded company. This indicates risk to monthly supports at 371.66 and 322.47. The NASDAQ has a negative weekly chart with monthly supports at 2120 and 2065 and the 200-week simple moving average at 2317. The SOX also has a negative weekly chart with a new 52-week low set last week at 322.24. Monthly support at 323.47 was thus tested and held last Friday. Lower monthly support is 317.74 with weekly resistance at 358.07. My second blip challenges one major reason cited for conservatorship of Fannie and Freddie. The idea that Fannie and Freddie debt and mortgages had an implied backing of the U.S. government is ridiculous. I traded Fannie and Freddie securities between 1972 and 1987, and everyone involved in the market during that time were 100% sure that these securities were not backed by the U.S. government. In fact, most of that period, Fannie and Freddie did not even have a AAA rating. Now, according to a Treasury fact sheet published Sunday, investors have purchased securities in these GSAs in part because of ambiguities fostered in their congressional charters created a perception of government backing. Because the U.S. government created these ambiguities, we have the responsibility to both avert and ultimately address the systemic risk now posed by the scale and breadth of holdings of GSE debt and mortgage-backed securities. Anyone believes this ought to go back to English 101, as there were never any misconceptions, in my opinion, about the fact that GSE debt and mortgages were not backed by the full faith and credit of the United States government. Any ambiguities are hogwash and results in a huge form of pork barrel spending to bail out investors who just didn't know how to read. The market knew it with those wider spreads between the GSA and U.S. Treasuries. Now U.S. taxpayers are on the hook. The U.S. government is now over its debt limit and should be shut down until a debt ceiling is raised. My third blip looks at U.S. Treasury yields and Fannie Mae and Freddie Mac spreads. The yield on the 5-year U.S. Treasury traded between 2.75 and its 50-day simple moving average at 3.185 since last Friday. The 50-day held as support on Monday. The 5-year Fannie Mae spread declined from 94.5 basis points on Friday to 63 basis points on Monday. Shouldn't this be closer to zero, given the newly anointed government-backed guarantee? According to Mortgage News Daily, the 30-year fixed-rate mortgage declined just 5 basis points on Monday to 6.35. Where's the relief? My fourth blip looks at the regional banking index, the BKX. The BKX is trading between its 50-day at 63.09 and its 200-day at 77.7, which was last tested, that is, the last time that the BKX was above its 200-day simple moving average, was back on July 17, 2007. Members SunTrust Bank, symbol STI, and Zions Bancorp, ZION, have been downgraded to sell this morning and should be sold versus 200-day simple moving averages at 53.20 and 41.74 respectively. If you have any comments or questions or want to order a copy of my special report covering the Great Credit Crunch, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.